would like to welcome everyone, both here at our City Council chambers on the 12th floor of the City Administration Building, to our Solutions for a Sustainable San Diego seminar. We have this evening, for our forum, a very distinguished panel, not just of academics, but of business folks, investment specialists, environmental specialists, all of whom are deeply involved in the new enterprise that our city of San Diego and cities throughout the state of California, throughout the United States, throughout the Western Hemisphere, and really throughout the world are engaged in the same exercise. And it's a very important exercise as we transition from a growth-oriented economy to a sustainable economy. Next is Shane Yonston. Shane is the founder and principal of a local responsible investments group. He is a comprehensive financial planner specializing in socially responsible investments. He focuses on combining client values with winning portfolio solutions and has led dozens of workshops and seminars dealing with this approach to investment advice. And Shane was very instrumental in getting this organized tonight, and I want to thank him very much for providing the leadership to the City Attorney's Office to help us pull this together.
Thanks, Mike, and I'll reiterate what Rob said. Thank you, everyone, for being here, and I do think it's important that we talk about these issues. To sort of set some context on what Judy and I will talk about, it's not necessarily the first thing that comes to people's minds when we think about the issues of sustainability and the ecological challenges that we're facing. The idea of finance or the economy probably, isn't the first thing that pops up. Things like energy or transportation or green building might be more on the forefront of the mind. But this slide here, this introduction, kind of shows, I think some of you might have seen this before. It's in a very famous presentation that's won some Academy Awards. But it is one of the things that we point out about the slide is it's a false representation of reality, really. It's kind of making us choose between one or the other, right? The planet Earth or the gold bars. And what everybody is up here to talk about is, actually making gold bars off of being good to the Earth. And that's a really important concept, I think. Rob, you mentioned it's just getting through the skulls of people. And at one point I was asked to define what is sustainability. And the first thing that came to my mind was really it's about focusing on long-term profits rather than short-term returns. And maybe that came to mind because of my financial perspective. But the more I thought about it, the more I believed myself. That makes a lot of sense. And if you think about the economic system, and one of the main purposes of the economic system is to measure the success or the growth of our economy, of our society. And as a measurement of success in relation to sustainability, we have to ask ourselves, is it measuring the sustainable success or progress of our society? And what we're going to talk about is responsible investing or sustainable investing. It's got a lot of names: green investing, socially responsible investing, but really the concept behind it is the same. And from a system-wide perspective, that is what it's about. It's about sustainably measuring the success of our societies. And from a personal perspective, it's more about contributing to and profiting from industries that are creating a sustainable society. So for example, in January, the LA Times ran an article on the Bill and Melinda Gates Foundation. I don't know if some of you were familiar with what happened. Basically, the LA Times did an analysis of the $32 billion foundation. It's the largest foundation in the history of mankind. And what they found was that over 41% of the investments of that $32 billion foundation were invested in companies that were causing negative social and environmental impacts on the world directly opposite to the positive benefits that the foundation was set up to produce in the world. So sort of like shooting themselves in the foot. So part of this having to choose between one or the other is that when we get rid of that concept and we say, wow, we can do both, we see that there's more efficiency in the foundations and in the businesses that we're putting together, because it's not if or that, it's a and, right, putting it all together. And it's not a concept that's new. It has gained a lot of attention the last couple of years with climate change and with the Bill and Melinda Gates Foundation was a big news piece. But it's something that's been around for a really long time. So with $2.3 trillion plus behind the responsible investment industry, there have been some successes. For example, this last year, climate change was a big issue. So we saw a lot of share owners filing resolutions with companies asking them to disclose their greenhouse gas emissions. And some of the oil companies, larger oil companies that were asked to create those kinds of reports were very cooperative and in fact said, yes, not only will we produce a report, but we will try to produce some benchmarks that we can mitigate our greenhouse gas emissions over a set period of time. And there were other large oil companies that refused to produce that kind of report. And then after the resolution is filed, if the company refuses to acknowledge it or negotiate terms that the share owners are okay with, it goes to vote. And what we saw this last year was actually the most profitable company in the U.S. had the largest percent shareholder agreement to actually produce that kind of report in the history. It was 41% of the share owners said, yes, we do want to see that report. So there's some real acknowledgement that these risks of doing business are important, and not only are they important because for moral reasons, but they actually can affect the company's bottom line. So as shareholders, we need to know about that. There was another company that was in the apparel industry that today, actually, it just came out with the third annual report, sustainability report is what they call them. And this apparel company, I don't know if anybody here knows about the apparel industry. In general, it has a very difficult time with sweatshop labor. And the reason is because they will subcontract out the production of clothing materials so many layers down, they don't even know where it's really getting produced. So this apparel company, publicly traded company, agreed 3 years ago to start producing a report on all of the labor standards and all of their subcontractors around the world, and they're a major apparel company. So for them to do that openly and willingly was a huge victory. And today they came out, like I said, with their third report showing a lot of progress in helping to increase the working conditions and stuff. So that's the shareholder action part, and putting influence on companies to act in a more sustainable way. The way that works, though, is it's like any investment process, which I'll show you right now. If you just click the button a couple of times, you can see that investors, to conceptualize this, go to investment managers who then put together a portfolio, and that portfolio goes up and down, a lot like the market did today. The way they put together that portfolio and picking stocks to go in there is they're going to do a quantitative analysis of all the companies. They're going to look at their cash flow and their price to earnings, et cetera. They're going to do a second layer of analysis after they're done with that and they've gotten rid of some poor financial companies. They're going to do a qualitative analysis. So they're going to look at the managers, they're going to look at the business plan, the patents pending, the research. So more of the soft side of business, not so number crunching. But when they're done with that, they'll have a portfolio together, and you, an investor, will be happily invested in the right companies. The responsible investment process is very similar. They're going to do a quantitative analysis first to pick the best, most financially sound companies. They're going to do that same qualitative analysis, but then there's going to be a third qualitative overlay. So out of the companies that are remaining, they're going to say which one of these has the best corporate governance practices, which ones have the best reputation in their communities, which ones have the best environmental practices. So it's also called best-in-class investing because what you end up with are the most environmentally and socially responsible companies in your portfolio. And what also results from that is that you're mitigating a lot of risk. For example, climate change is just one responsible investment issue. It's the issue of our time and perhaps maybe the biggest issue that humankind has ever faced. I don't know if I am able to say that, but it's a big, I don't mean to downplay it. It's important, but it is just one issue, and it brings up a lot of risks. If you're doing business in today's environment, you have to pay attention to physical risks of doing business, hurricanes and outlandish weather environments that we can't predict as accurately anymore, floods, rising tides. These things, if you have operations on the coastline, they actually produce a physical risk, as we saw with Hurricane Katrina. The regulatory risk, more and more regulations are being passed to put limits on greenhouse gas emissions. We have AB 32 in California. If you're a company that's not paying attention to the potential regulations coming down the pipeline, you are exposed to more risk than a company that's more progressive and actually getting ahead of the curve. Litigation risk, again, with Katrina, we saw a lot of shareholders suing companies that weren't properly prepared for the risk of a hurricane, and therefore they lost a lot of money with companies that did business in New Orleans. So there's litigation risk, there's competitive risk. Obviously, if consumer decisions continue to go more towards favoring green companies, companies that have these reputations for not being green or not being socially responsible, are going to lose out on revenue sharing, on revenue in the marketplace. So those are some of the risks, but of course, as Lisa pointed out earlier, this produces a lot of opportunities. And the energy sector, the transportation sector, food sector is something we don't have represented on the panel today, but the organic food industry has grown 20% a year for the last 2 decades. A lot of people don't know that 70% of nitrous oxide emitted in the U.S. comes from the agricultural sector, which is also a greenhouse gas. Green building forecasts to grow at 40% a year up until 2010, and by 2010, McGraw-Hill predicts that almost half of the homes will be built with some kind of green, solar panel or some kind of greening to them. So there's a lot of opportunities as an investor. And so in a nutshell, you could say that responsible investing avoids companies that expose themselves to unnecessary risks, such as having poor environmental standards or creating unfavorable consumer perspectives due to poor social relations or labor standards. And it's going to seek out companies that have a long-term view on sustainable profits, such as those that, again, have above regulation standards or staying ahead of the curve, and in effect the risk gets lowered by choosing more responsible and stable companies.
Thank you very much. Again, that will all be on the City Attorney's website. You can get that at sandiegocityattorney.org. All these PowerPoints will be posted, as well as this film of tonight's session.